Hello everyone, John A.G. here, and let me start with the one question everyone is asking today. What exactly happened to silver in the last 24 hours? And why did the price suddenly feel like it hit an invisible ceiling? Here's what happened. We walked into a major derivatives expiration window, the kind of day where paper contracts decide whether the official price prints higher or gets shoved lower. And within hours, you could see the fingerprints. A quick push down, a fast bounce, and a whole lot of noise meant to make normal people second-guess their conviction. And that matters because what you're watching isn't just a chart move. It's a stress test. A test of how much physical demand the system can handle while the paper market keeps pretending it can create infinite supply. So in this video, we're going to break down the mechanics behind that push-pull, why it happens around expiry windows, what it signals about the pressure building underneath, and the one place where the real price keeps leaking out, whether the headlines want you to notice it or not. Now before we dive in, quick favor. My analytics are blunt. Most people watching these videos still haven't subscribed. If you get even a little value from this kind of breakdown, hit subscribe right now. It costs nothing, it helps more than you think, and our target is 50,000 subscribers in the next 30 days. Let's actually do it. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members and the John A.G. family. If you want in, click the join button right now or use the link in the description. All right, let's talk about the breathing space silver took today, because yes, oddly enough, I'm glad it did. When silver runs hard, everyone gets emotional. Bulls start yelling to the moon, bears start chanting top is in, and the market makers quietly do what they always do. They look for the moment with the most leverage, the most options exposure, the most paper positioning, and they press where it hurts. That's why these expiry windows matter. Not because they change the true supply and demand. They don't. They change the incentives for the biggest players in the paper arena, and those incentives can move the quoted price short term, even if the physical world is screaming the opposite. Here's the uncomfortable truth. Almost everything most people trade around silver is a derivative. Futures are derivatives. Options are derivatives. Many ETFs are derivatives. Even a lot of silver exposure products are just structured promises layered on top of more promises. And that's the first cliffhanger. If the system is mostly promises, what happens when too many people want delivery instead of settlement? Because that's when the game changes from price discovery to damage control. Now, I want to be careful how I say this, but I'm going to say it plainly. The paper market can create a mountain of short positions with a few keystrokes, and that ability gives certain institutions a kind of power that feels unreal. Think about the scale. On many days, the notional volume of silver traded in paper form can be multiples of annual mine supply. Multiples, in a single day. That's not a market, that's a casino where the chips are printed on demand. And if you've ever felt sick watching silver, like you're looking at a chart that doesn't match reality, you're not crazy. A lot of people have stepped away because they can't handle the whiplash. They look for oversight, they look for accountability, and what they find is a fog. Regulators exist on paper. Rules exist on paper. Enforcement often feels like it exists in press releases. So the question becomes, if the rules don't protect price discovery, what does? Answer: the physical market. The real metal, the stuff you can hold, store, and deliver. That's the only anchor that can't be rehypothecated into infinity. And it's exactly why the narrative wars get so aggressive whenever silver starts acting too strong. Let me give you an example of how this works. When the market wants you scared, you'll see a wave of stories about why silver is topping, why selling pressure is inevitable, why a pullback is guaranteed. It's always the same rhythm: confidence up, fear injected, weak hands fold. But if you step back and watch the behavior instead of the commentary, you'll notice something else. Every pullback gets bought faster than it used to. And that's not because the paper player suddenly got moral. It's because industrial users and real buyers are showing up, quietly, consistently, and with a deadline. Because industry doesn't trade silver for fun. Industry consumes it, and consumption doesn't come back. So here's the second cliffhanger. What if the world has been underestimating consumption by a lot? And the shortage isn't a future story, it's a present story. Let's talk about the biggest lie in commodity analysis. The lie that you can precisely model demand in a world where supply chains are strategic and inventory is treated like a national security asset. On spreadsheets, demand looks tidy. On factory floors, demand looks like panic procurement when availability gets questioned. And lately, you can see it in the spread between where silver is quoted and where it's available. One of the most telling signals is when different regions price the same ounce differently, consistently. When you see a persistent premium in one major market compared to another, that's not random, that's information. It tells you one market is closer to the physical reality than the other. It tells you somebody is paying up to secure supply. Now, could that gap close? Sure. But how does it close? Does the higher market crash down? Or does the lower market get pulled up because metal moves to the higher bidder? That's not just a theory question. That's an arbitrage question. And arbitrage is what exposes paper games, because paper games hate delivery. If a big buyer can source metal cheaper in one place, take delivery, and move it to where it's priced higher, they will. That's what markets do when they're real. So if the gap persists, you should ask yourself, what is preventing the clean arbitrage? Is it logistics? Is it timing? Or is it that delivery isn't as simple as the paper contract pretends it is? And I want you to answer this in the comments. Do you believe the official price is still the real price? Or do you think the real price is already showing up in premiums and regional spreads? Now here's where this gets even more interesting. People love to talk about a squeeze, but most people don't define what that means. A real squeeze is when shorts are forced to close, when they can't roll forever, when they have to buy back, and buying back pushes price up violently. But if open interest stays stubbornly high while price rises, that suggests something different. It suggests the short position isn't disappearing, it's being transferred, rolled, or disguised. And that's a dangerous game, because the longer a massive short position persists in a tightening physical environment, the more unstable the whole structure becomes. If the market ever flips from roll the paper to deliver the metal, the stress doesn't come in gentle waves. It comes like a trap door. Now, I'm not here to predict exact numbers on exact dates. Anybody claiming certainty in a manipulated market is selling you a feeling, not an analysis. But I will tell you the kind of move that happens when a crowded paper short meets a physical constraint. It's not a slow grind. It's a repricing event. It's the kind of move where you don't get to wait for the dip because the dip disappears. So what keeps the system alive right now? Two things: confidence and convenience. Confidence that paper will settle. Convenience that most participants don't demand delivery. As long as most people are trading symbols instead of ounces, the system can keep playing musical chairs. But the moment too many people want chairs at once, you find out how many chairs exist. Now let's address mining stocks for a moment, because people always ask, if silver is so bullish, why don't miners explode every day? Mining stocks are not silver. They're businesses. They have costs, politics, taxes, permits, energy exposure, and sometimes geopolitical risk that has nothing to do with silver's chemistry. And there's another harsh reality. When systems break, governments look for assets to control. Mines are visible. Mines are local. Mines are strategic. That's a risk, whether people want to talk about it or not. So if you're using miners, understand the trade. More leverage, more variables, more headline risk. Physical is boring, but boring is powerful. And speaking of boring, let's talk about the most boring move that might be the smartest move. Simply holding metal and refusing to be shaken out by paper theatrics. Because the institutions rely on your impatience. They rely on your need for constant action. If you can't be shaken, you can't be harvested. Now, I promised you we'd talk about industrial demand, because this is where the story becomes explosive. Most public estimates treat industrial demand like a steady river, but the modern world is not built on steady rivers. It's built on exponential tech adoption, electrification, and supply chain fragility. Silver is not a luxury input in many applications. It's a functional necessity. It's used because it conducts incredibly well and performs in harsh conditions where substitutes fail or reduce efficiency. That matters in electronics. It matters in power management. It matters in communications. It matters in automation. And it matters in solar. Now, I'm not here to debate politics. I'm here to debate physics and cost curves. If the world insists on expanding solar deployment, silver becomes a bottleneck unless technology reduces silver intensity dramatically or prices rise enough to force substitution. But substitution is not instant, and it's not free. It often means lower performance, higher failure rates, or more complex manufacturing. So you get this uncomfortable trade-off. Either pay up for silver or accept a slowdown in certain production lines. And that's why the silver is abundant narrative is so dangerous. It encourages understocking until the day everyone realizes they need the same ounce. Now, let's be practical for a second. If you're buying physical, do it like a grown-up. Don't chase hype listings at the worst premiums. Don't assume every online storefront has inventory just because it has a product page. Ask one simple question. What is actually in stock and ready to ship? Because in tight markets, the difference between available and advertised is everything. And this is also where I'll weave in something creative, like I promised. If you want silver-related success stories, real stories of people who positioned early, stayed calm, and won, check the link in the description to our second channel and subscribe over there too. It's a different vibe, but the lessons are powerful. Now, back to the main thread. Another thing the public underestimates is how fast sentiment changes when industry gets nervous. Retail demand can surge, but it can also pause. Industry demand behaves differently. When procurement teams fear shortages, they overorder. They lock contracts, they stack inventory. They do not want to be the person who shut down a production line because they assumed supply would be there. So, if industrial demand is even moderately higher than the official estimates, the difference is enormous. Because the global silver market is not infinitely elastic. Mines can't triple output on command. New projects take years. Refining capacity has limits. So the question isn't, is silver demanded? The question is, at what price does demand get rationed? And that's the part nobody wants to say out loud, because rationing is a fancy word for somebody doesn't get enough. Now, I'm going to touch a sensitive topic, but I'll keep it grounded. Accountability. We've all watched situations where huge institutions get in trouble, settle, pay fines, move on, and the public is left wondering how the behavior continued for so long. I'm not here to throw names around. I'm here to point out a pattern. When power concentrates, accountability tends to lag. And when accountability lags, markets get distorted. That's why you can have absurd notional derivative volumes compared to real inventories and still call it normal. It's not normal. It's tolerated. And toleration ends when it stops being convenient. Now, here's the next cliffhanger. What happens when the rest of the world stops respecting one market's rules? Because global trade doesn't care about anyone's ego. If another market offers better pricing and reliable settlement, capital migrates. Metal migrates. The center of gravity shifts. You don't have to announce it. You just have to watch where the flow goes. That's why regional pricing differences are so important. They're early warning signals of a shift in who sets the marginal price. And once that shift accelerates, the paper market can scream all it wants. The physical market will quietly decide. Now let's talk about what the end game looks like, because a lot of people fantasize about it and miss the reality. The end game is not a polite confession. It's not a press conference where someone admits suppression and then everyone holds hands. The end game is usually rule changes. It's usually emergency measures. It's usually settlement adjustments and trading halts. When a system is under stress, it protects itself first. So if your entire strategy is built on the idea that you'll just click sell at the top and everything will function perfectly, you might be disappointed. Real stress events don't behave like normal days. That's why I keep coming back to the simplest concept: control. If you want exposure, you can buy symbols. If you want control, you own the asset. And control is what matters when the rules start changing. Now, I want to address something that's going to make some of you uncomfortable. You might be early. Yes, you might be early. But being early in a structural repricing thesis is not the same as being wrong. Being early means you need a strategy that doesn't require perfect timing. That's why accumulation matters. That's why dollar cost averaging matters. That's why position sizing matters. Because the moment you go all in emotionally, you become easy to shake out. The goal isn't to be dramatic. The goal is to be positioned. Now, before I go deeper, let me plug the 2 value adds again, briefly because I don't want to ruin the pacing. First, subscribe. Seriously. Most viewers aren't subscribed, and it's honestly frustrating because it tells me people want the value but don't want to support the work. If you appreciate it, subscribe and help us hit 50K in 30 days. Second, description links. Bonus links are there for you, including the premium WhatsApp channel link. Use them. All right, now let's talk about deliveries and inventories in a way that actually makes sense. There are months where delivery activity is expected and months where it's usually quiet. When quiet months start acting like busy months, that's information. It means more participants are choosing to stand for delivery, which means they either need the metal or they don't trust the paper settlement. And that's a key behavioral shift. Because once standing for delivery becomes normal, the system has to either deliver more metal or discourage delivery. And discouraging delivery usually looks like fees, rule tweaks, and cash settlement incentives. And if that starts happening, it tells you the pressure is not hypothetical. It's here. Now, who ends up holding the risk in these moments? Often it's whoever is last to adjust, whoever believed the old assumptions the longest. In a world where some institutions can shift positions quickly and others move slowly, the slow movers get squeezed by reality. And that brings us back to open interest and persistent shorts. If shorts don't close, they're betting they can always manage the paper. They're betting rules will protect them. But rules can't create metal. Rules can only manage perception. Metal is metal. Now I want to talk about the psychological trap people fall into. The trap of thinking, if this was real, it would already be obvious. That's not how big changes happen. Big changes often look stupid right up until they don't. Right up until the day premiums explode. Right up until the day deliveries get delayed. Right up until the day a major product goes temporarily unavailable for longer than expected. and then suddenly everyone sees it at the same time. And that's when you get the stampede. So the smart question is not, is it obvious? The smart question is, what signals are early, and are they flashing now? Regional price gaps, rising delivery interest, tightening retail inventory, industrial procurement behavior. Those signals matter more than headlines. Now, let's address the how high can it go obsession, because it's both natural and dangerous. Natural, because people want a target. Dangerous, because targets can make you rigid. If the system is facing a repricing event, the move can overshoot what people think is, quote, reasonable. It can overshoot because price is not just about value, it's about clearing the market. Price is a rationing mechanism. When supply is constrained and demand is urgent, price has to rise until demand slows or supply increases. If supply can't increase quickly, price does the work. So instead of fixating on a single number, think in phases. Phase 1, paper volatility and suppression attempts. Phase 2, physical premiums detach. Phase 3, delivery stress and rule changes. Phase 4, repricing and normalization at a new level. We're not guaranteed to follow that exact script, but those are the typical chapters. And the transition between chapters can be fast. Now, I promised you retention, so here's the next hook. There's a specific reason why silver is the most uncomfortable metal for the system. Gold can be hoarded, silver is consumed. Gold sits in vaults. Silver sits in devices, solder, contacts, and industrial applications. That means silver stockpiles can shrink invisibly. The metal doesn't return easily. It disperses. So if the world underinvested in mining and demand quietly rose, you can get a situation where available above-ground silver becomes the real scarcity, not silver in the earth. And that's why the price can move in a way that shocks people. Because the market doesn't care how much is theoretically underground if it's not economically extractable at current prices. Now, a quick note for those of you who are successful already. Maybe you've done well in markets, business, or anything else. Share a quick win in the comments. Seriously, tell people what worked for you. It helps the community, it raises morale, and it reminds everyone that success is possible even in messy environments. And let me ask you a second engagement question. If you could ask one thing of the people running these markets, one demand, one rule change, what would it be? Drop it below. Now, there's another layer to this story, the broader financial system. When derivatives dominate pricing, it's not just silver that's affected. It's currencies, it's energy, it's rates, it's everything. You can live inside that reality, but you should not be blind to it. When a few institutions hold enormous derivative books, the system becomes fragile because the math becomes too big to unwind cleanly. And fragile systems don't break in slow motion. They break when a trigger hits. Sometimes the trigger is liquidity, sometimes it's geopolitics, sometimes it's a supply shock, sometimes it's simply confidence evaporating. But the trigger doesn't have to be silver. Silver just exposes the fragility. Because silver is a small market compared to the money sloshing around in global finance, which means it can be pushed, but it can also snap. And when it snaps, the move can be violent. Now, I'm going to give you a practical checklist because you deserve something actionable. If you want to be prepared, consider 1. Don't rely on a single paper vehicle for all exposure. Understand what you own. 2. If you're buying physical, prioritize trusted sources and in-stock inventory. 3. Don't over-leverage. If you're forced to sell due to stress, the market will exploit that. 4. Set expectations for volatility. Paper can push price around in the short term. 5. Keep your head. Hysteria is expensive. And yes, I'm aware that people will clip this and call it conspiracy. That's fine. Labels don't change how settlement works. Now, let's talk about why certain analysts consistently understate industrial demand. Sometimes it's incompetence. Sometimes it's outdated models. Sometimes it's incentives. If your business depends on access, relationships, and being invited back to the table, you don't always tell the most uncomfortable truth. You tell the truth that's safe. But in markets, safe truths are often late. That's why independent analysis matters. Not because independent people are magically perfect, but because they can afford to be wrong publicly without losing access to a club. Now, I'm going to circle back to expiry day behavior because it ties everything together. On expiry days, you get maximum sensitivity to strike prices. You get maximum incentive to push price toward levels that make certain options expire worthless. That's not a theory. That's how options mathematics works. So when you see abrupt moves that don't match news, don't assume it's random. Assume it's positioning. And then ask, what happens after the expiry window passes? Often, you see a release, a snapback, because the pressure campaign has a deadline. So if you're watching today and thinking, why does it feel artificial? You're probably feeling the truth. Now, I know some of you are thinking, okay, John, so what's the next big sign? Here it is. Watch for sustained price strength after the expiry window without a corresponding drop in delivery interest. If price holds and delivery interest stays firm, it tells you real buyers are absorbing the paper attacks. And if real buyers absorb paper attacks long enough, the paper side has to either escalate or retreat. Escalation looks like bigger raids, more volatility, louder narratives. Retreat looks like price finally climbing in a way that feels surprisingly smooth. And when that smooth climb starts, it tends to pull in the last wave of people who were waiting for certainty. That's when moves accelerate. Now, I'm going to do one more quick pitch because it's a must for this script and it's genuinely valuable. We are offering members-only videos, and those are different. We have a separate team working on them, doing deeper research and cleaner sourcing, so premium members get more context and more detail than we can fit into public videos. If you want that level, consider becoming a member. All right, back to the action. Let's talk about premiums and availability, because this is where regular people feel the change first. In a loose market, you can buy common products anytime. In a tight market, everything becomes call for pricing, back order, or limited allocation. And when allocations start showing up, it means wholesalers are managing scarcity. Scarcity management is a fancy way of saying the pipeline is thinner than demand. Now imagine what happens if industrial buyers start competing with retail for the same marginal ounces. Retail gets priced out first. Not because retail doesn't matter, but because industrial contracts are big, consistent, and tied to production. So if you're stacking physical, understand that the retail window can close faster than people expect. Not forever, but temporarily. And temporary closures cause panic, and panic is fuel. Now, let's go one layer deeper into the options expiry trick, because once you see it, you can't unsee it. Options are not just bets, they are magnets. When a huge chunk of open interest piles up at certain strike prices, the market has a financial incentive to drift toward levels that make the most contracts expire worthless. That's why you'll sometimes see a price get walked down slowly, then suddenly punched lower, then allowed to recover just enough to confuse everyone. It's not randomness, it's math around payouts. And here's the part most people miss. The largest players can hedge and roll these positions in ways normal traders can't. So the game isn't fair the way a textbook describes it. So what do you do with that information? You stop reacting to every intraday jab, and you watch what happens after the calendar event passes. If price snaps back quickly, it suggests the drop was incentive-driven, not demand-driven. Sometimes the most bullish thing you can see is a forced dip that refuses to stay down, because it means the market is trying to push it and failing. Next, let's talk about the inventory problem, without pretending we have perfect numbers. Public inventory categories can sound comforting, but stored doesn't always mean available. Metal can sit in a warehouse and still be owned by someone who isn't selling. That's storage, not supply. So the real question is, how much metal is for sale at the current price? And you can feel the pressure when delivery interest surges during normally quiet periods. When a non-event month starts behaving like a delivery rush, that's a signal. It doesn't prove the fire is everywhere, it proves smoke is present. Now consider the global buyers people underestimate: industrial users, price-sensitive savers, and regions that treat metals like strategic inventory. When those groups overlap, demand becomes relentless. This is also why the old industrial demand is only a few 100 million ounces story feels increasingly outdated. Add up electronics, grid upgrades, EV components, data centers, medical uses, and solar, and you start to see why many serious observers argue industrial draw could be far higher than the comfortable estimates. If that's even partly true, the market isn't merely tight, it's structurally short. And here's the hook. Paper can hide a shortage for a while, but it can't hide a shortage from factories forever. Factories don't run on narratives, they run on input flows. The moment procurement teams start competing for allocation, you get a quiet bidding war that never appears on a headline banner. You only see it in lead times, premiums, and sorry, we're out. Now, practical advice again, because I'd rather you be safe than entertained. If you buy physical, spread your risk. Don't send all your money to one place you've never used before just because the quote looked a little cheaper. In tight markets, the cheapest quote is sometimes the riskiest quote. Work with reputable sources. Verify what's actually in stock, and if you keep hearing vague delays, 2 more weeks, shipment coming soon, check back later, take that seriously. The worst outcome isn't paying a slightly higher premium. The worst outcome is paying and never receiving metal. And I'll weave in the promised creative plug, quick and smooth. If you want silver success stories, real people, real decisions, real outcomes, there's a link in the description to our other channel. Subscribe there too and binge a few stories. It'll sharpen your mindset. Now, one more misconception. If silver rises a lot, everything gets too expensive, so it can't go too high. That's not how markets clear. If silver is constrained, it rises until demand gets rationed, and rationing hits different industries at different times. Some pay up, some redesign, some pause. That's the real world. So the last cliffhanger before we finish is this. What happens when the public realizes silver isn't just an investment story, it's an infrastructure story? Because when that realization hits, demand isn't only from stackers and speculators. Demand becomes defensive, and defensive demand is the hardest kind to stop. And don't ignore what's happening quietly in Asia. When large import flows keep showing up and local premiums stay sticky, that's the market voting with money. If you think that's just speculation, ask yourself why buyers keep returning week after week, even after pullbacks. Now, to wrap this up, here's what I want you to do today. 1. If you haven't subscribed, subscribe. Let's hit 50K in 30 days. 2. Check the description for the bonus links, including the premium WhatsApp channel. 3. Answer the questions in the comments. Do you think the official silver price is real? And what rule would you change if you could? 4. If you're successful, share a win so others can learn and stay motivated. And 5. If you want deeper research, consider joining as a premium member for the members-only videos. Because the next phase of this story won't be announced politely. It will show up in the data first and in the headlines later. And when it does, you'll want to be the person who understood the setup before the crowd arrived. I'll see you in the next video.